Having trouble managing different currencies in multiple jurisdictions? Then today's video is for you. My name is Rusudan. I have been working with Nomad Capitalist for the last 4 years, helping high net worth individuals legally reduce their taxes and go where they are treated best. Today's topic is managing multiple currencies in your global business. And I know that this is not a very exciting topic, and I think that some of you may think that it's very difficult and a big subject to take over. But at the end of this video, I am going to show you that there are simple strategies that you can implement in your business that will help you make sure that you are managing and planning for currency fluctuations the best way that your business can do. The first thing that always comes to mind when talking about a global business is that you are present in more than one jurisdictions. It is highly likely that you also have to deal in different currencies. So maybe your clients are paying you in one currency, and then you have a vendor in another country that you have to pay in another currency. So it means that you take on a risk of the conversion rates, and you take on a risk of different currencies fluctuations. As you know, in today's economic situation, not in every country is very stable, and in some situations it's very volatile. So you have to make sure that you have a plan for that, and you are not dependent on certain one currency. The starting point for you is to make sure that you choose the right currencies that you are invoicing your clients in. For example, if you have a vendor that you have to pay in British pounds, maybe it makes sense for you to also be getting funds in British pounds, or vice versa. If you're only dealing with client payments in US dollars, maybe you can just coordinate with your vendors to make sure that you pay out in US dollars, and thus you will not be taking on the conversion risks on yourself and the fees on yourself, because converting from one currency to another can be really rather expensive transaction, depending especially on the pairing of the currencies. The first thing that you have to think about in this situation is think about all the pairs of the currencies that you are dealing with: US dollars, euros, Great British pounds, Singapore dollars, etc., and make sure that you are aware of how these specific currencies are acting, and if there's any issues on the market that you should be aware of. Think about which of your currencies are like that, and maybe think about keeping some funds in those currencies. And for the currencies that are maybe a bit more risky, there are several things that you can do. The first thing is maybe there are some payment platforms that could be of help to you, because if you're only dealing with banks always have not the best conversion rates. So if there's a way for you to connect some other types of platforms where maybe they are better and beneficial to deal with in foreign currencies, that would be helpful in your overall costs. For example, you use Wise for some transfers, and because Wise has reach in different currencies and it's not that expensive to convert, it will save you some funds, and it's also maybe a bit more transparent on what you're paying your fees for. Is it a transaction fee? Is it a conversion fee? One other thing is to have multiple currency accounts. If you're dealing with vendors in different accounts, if there's a way for you to maintain your own account in those currencies, it will be definitely beneficial, because at the very least you will have control over the conversion. Because if you have only US dollar account and you are paying a vendor in euros, then you have no choice but to send US dollars, and you don't have any control over how that's going to be converted on the vendor side. But in another scenario where you have both euro and US dollar accounts, you can maybe convert within your bank account, and it can be cheaper, because you can in some cases maybe have a contractual agreement with the bank where for certain amounts they will give you a beneficial rate that would otherwise not be available to you. In most cases, doing the conversions a lump sum conversion instead of for every $100 may be cheaper than converting for each transaction. So basically what I would do in this case is think about okay, in the next 3 months I'm gonna have to pay 10 vendors, and it's gonna be 10,000 euros. So what I would do is I would convert 10,000 euros today in a lump sum and just have that in euros, and then make the payments out whenever I need, compared to when I just convert each $100 the day before when I have to pay the vendor. So it is definitely going to be cheaper, because in some cases if you're converting a larger sum, they are going to give you a better rate than for smaller amounts. This is something that helps manage and mitigate the risk of conversions. In addition to the multiple currency accounts that you can hold, you can also maybe have an agreement or with the bank, forwarding contract agreement, where you know that in 6 months you're going to have to pay like, I don't know, $100,000 to somebody or 100,000 euros to somebody. So what you can do is go to your bank and tell them, I will need $100,000, and you lock in the rate that they have today, and that will make sure that you are not dependent on the rates changing in the next 3 months. So that is also a very common practice of hedging against the volatility of the currencies. One other thing that maybe we don't always pay attention when we're doing business globally is which is the currency that you're invoicing your clients in. So what happens, and what I've seen happen with clients, is like, because you are, for example, from the UK, you are more used to and feel more comfortable with the Great British Pound. So you think that maybe maintaining your agreements and invoicing your clients in this currency is easier for you. But then when you grow your global business and you have customers in different countries, you have to think about maybe you need to also start diversifying your invoicing. Maybe you need to invoice in different currencies that you can use for vendor payments later. You also do not depend on the conversion rates and like the conversion fees if they pay you in Great British Pound, and then you have to convert it into US dollar or into like more exotic currencies especially. Then it gives you flexibility of just owning the currency that you may need in the future. What helps is like just having an infrastructure. Maybe your accounting software allows you to invoice in different currencies, like QuickBooks has that option, for example. And depending on where your client is, invoice in those currencies, and just make sure that you have a bank account that can support receiving funds in those currencies, and you are all set and you are not dependent on the currency fluctuations. What is the biggest challenge with multiple currencies? So the biggest challenge there is the volatility of the currency and the fees and the loss that you can maybe bear because of the currency fluctuations. One of the ways to mitigate that is to have a good plan with the cash flow. So what you're going to do is you're going to think about, for the next 12 months, this is what I'm going to be doing. So these are the expected client payments, and these are the currencies that I'm going to be getting these client payments in. And also this is the vendor and the expenses that I need to pay out. And also these are the currencies. So now you had to think, like, how do I match that? The first thing that you think about is getting the funds in the currencies that you need. And that can be a one-time thing. Like if you know that in 6 months you're going to have a big payout in euros, just make sure that one of the clients pays you in euros. And it just takes away the paperwork and everything else related to exchanging the currency, and also like just keeping an eye out on the currencies. And the other thing that could potentially help you is making your agreement with the vendor a bit more beneficial for you. So what I say here is that, for example, you agree that you're going to pay the vendor in euros, and you can also add a clause there that says that if the exchange rate for euro to X pairing, whatever your other currency is going to go above certain range or below certain range, you guys will like renegotiate or maybe to fix it at that price. I think that in general, fixing currency rates, if possible, is a good way to mitigate things if it's a one-time payment or one-time service fee that you are paying to your vendor. And even if it's a continuous service, the more clear you are on how much it's going to cost you in your like native currency from the signing of the agreement, the better it is, and the less of the risk it is for you to pay out in different currencies. So even if you have to pay like in euros, you know from the beginning how much is it going to cost you in US dollars. One other thing that I've seen help with managing multiple currencies, working with fintech, like not traditional banks, but a bit more like a modern banking, because the way that they work and the way that they try to attract more customers is be a bit more accessible to compared to the traditional banking. So it means that they have more features, and it means that maybe they always kind of have the same type of features that maybe you will see in Wise or in Revolut, in like payment platforms, where they give you the opportunity to pay out in the currency that the vendor has to receive in, and not only be paying out in your like native currency. Like if you're working in euro, it doesn't mean that you're going to be paying out in euro. It means that they give you the option to convert internally in your bank account and pay out British pounds or any other currency that you had to. One other thing that also in this situation, like internally for Nomad, for example, is that we think about like, if I know that I'm going to have to pay a lot of sums in Georgian laris, for example, I will think about like maybe it makes sense for me to maintain a Georgian lari account in Georgia, and that way I can plan the cash flows in this currency better compared to when I would just randomly, whenever needed, pay it out in this currency. Or just even think about where to bank, not only which accounts to hold, but where to bank to make sure that I'm not taking on a large sum of fees for maintaining and converting into certain currencies. Additional way to mitigate your risks. For example, you're working in US dollars and you know that in the future you're going to have some kind of Hong Kong dollar outgoing payment that you have to make. Let's say Hong Kong dollar right now is volatile and you do not know exactly how much it's going to cost you, or you think that it's going to be expensive to get the funds now, or you're like just looking at the best timing. That's kind of called hedging, where you just choose the right time to convert to a different currency. And while you're doing that, the good way is to maybe have a term deposit in US dollars. And in that way, at the very least, for the time being, while you're thinking about like, should I convert today or should I convert in like 3 months, your money is not sitting around doing nothing, and it's actually gaining you some kind of interest gain while you're waiting for the best time to convert to the currency that you will actually need in the future. I hope now you have a better understanding of how to manage different currencies in multiple jurisdictions, and you know what kind of steps you need to take to make sure that you mitigate your risks, reduce your costs, and are not dependent on different volatile exchange rates and currencies in multiple jurisdictions. Please don't forget to like, share, and subscribe, and I will see you in the next episode.